Good morning, Propenomix people, and hello, Property and Propenomics people as well. So thanks for tuning in. Today is all about the Bank of England and how they've wasted billions and billions and actually tens of billions of pounds worth of taxpayer money. Now, this is, I think, the biggest scandal that there's essentially, in terms of economic size, in terms of scale, that there's ever been really in the United Kingdom. You're talking on a scale that's not dissimilar to the financial crisis when you really get into it. But no one ever says anything about it. I'm not sure whether that's just because there's only a handful of people in the whole of the country who really understand it. The bad news is most of the damage has already been done, but there might be some good news in there somewhere. So for those who haven't listened before, I like to start with a quote, and this week's was, "Journalism is printing what someone else does not want printed. Everything else is public relations." And that was by the great George Orwell, visionary and author. So this is pushing forward towards what we've got in the deep dive. I felt the blood pressure rising just there as I even thought about writing about this topic, which I do at least once a year, talk about it as the quantitative tightening review comes round for the Bank of England. But I think we really just need to face the truth about just how much taxpayer money the Bank of England has actively wasted and is wasting around their poor strategy and tactics around quantitative tightening. So before I go in full hammer into this one, Rod and I will be running our next property business workshop on Wednesday, the 1st of October in London. The subject matter this time around is investment, with an emphasis on what metrics you really need to be considering to run your property business properly and to help build your business to scale. We dig into the real fundamentals of property investment for growth, from proper valuation and strategic debt structuring to the investment metrics that serious pros use. Little hint for you, you'll be ditching ROI and yield. But learn why some deals work for some and not others, how to manage risk as your portfolio scales, and when to shift gear from side hustle to scalable business. We'll break bottlenecks, build strategic pillars, and unpack real-life case studies of fast company growth. How have we done so many deals? Well, we'll tell you. You can still book super early bird tickets with 20% plus off the face value now at bit.ly/PBWEIGHT, and that link is also in the show notes. But I'll kick off this week, as has become customary, with Trumpwatch. I wonder if we'll be persisting with this section through 2028, as the Americans would say. I suspect it will probably endure. So a second 90-day extension was signed for China on tariffs with hours to go until the deadline. The new date for the diary is November the 10th. It's hard to really see this as anything other than advantage China, you would think. He really doesn't want to bring what he's threatened into play, is how you'd read it. But we'll see, won't we? On the river, to preserve the bluff and so as not to look too weak, the mention of semiconductor tariffs coming soon, hinting at some triple-digit level tariffs. And this is one element that does make an element of sense, since the US has poured a lot of time, money and effort into making semiconductors inside the US because so many were being imported from Taiwan. Aside from anything else, there were multiple reasons why the US wanted to lower that amount of dependency. And it could be one of the areas that is a little easier to measure the impact than many of the others, which have been a little bit opaque, but have started, you would think, to filter through into inflation in the US figures. Otherwise, you're ignoring some fairly significant circumstantial evidence, I would say. The lucky chair of the Federal Reserve was threatened with the lesser spotted Trump lawsuit, which, of course, has been a favourite tool over the years. After inflation held at 2.7 on CPI, even though expectations were to rise one tick, core inflation hit 3.1 in the US. It was 2.9 the month before, and the expectations were 3%. Now, this might be a small nuance. The markets actually saw an increased probability of a 50 basis points cut in the US base rate for September, but the core is usually the one to watch for what's really going on. And what's really going on is the 3% world, not the 2% one. It's only been 6 months since core CPI in the US was this high, and between June 24 and February 2025, it was hovering between 3.1 and 3.3. But the graph is back on the upward curve again. I just get the feeling that if you ask Mr. Trump, he'd just shrug his shoulders and say, so what? And whilst 3% inflation is not the end of the world, the so what is that you have your largest independent quasi-governmental organisation, the Federal Reserve, targeting 2% inflation. Now, he's addressed this in a way, or perhaps Scott Bessent has as his proxy. There's talk, as flagged over recent weeks, of moving away from inflation targeting. I can't really express to you in words just how much I think this would negatively impact bond markets. As soon as you put inflation down your priority list to your second priority even, fixed income investors are bound to be concerned about how high it might go. It seems an inescapable trap to me, without a restructure during a crisis, of course, but write-downs on US bonds would truly question the current global financial world order. Personally, I wouldn't think, with all else being equal, with an independent central bank, that it looks like a cutting cycle. And I shared similar evidence-based posts this week on my LinkedIn, but the political pressure and messaging is clear. So I'm sure cuts are in the mixer next up for US bonds, and the UK will not be complaining because it's helpful to our cost of debt too. But we will see. Over to our specialist subject on this side of the pond, the real-time UK property market. Chris Watkins delivers again. We've reported on week 31. Listings printing 32,700. Another tick down as the school holidays continue around the country as far as the figures go. And they're now only 3.7% higher than 2024 year to date and 7% higher than the pre-pandemic market. So my sort of ready reckoner of 10% more stock than a normal market is still working on the back of 2 years of overperformance in listings compared to the historical averages, or we're into that second year of overperformance anyway. We're 12.1% ahead of the 9-year average, although that does include 2020, which pollutes the figures somewhat. We're really coming back to the 2024 listing numbers now, having been 6 or 7% ahead of them at various points during the year, but we're still listing more than we're selling. So it generally just depends, the amount of stock depends on how much is being withdrawn as a general rule. Only 21,800 price reductions in week 31. That's 14.1% as July's official number, 14% reduced in June. We're still seeing similar sorts of rates of stock being reduced. That's come down a bit in August, you can tell, because the reductions have come down under 25,000. They were sitting above 26, 27,000. In May, we saw 13.4% reduced, and the 5-year average of reductions is 10.6%. So we're seeing more stock and more reductions, both absolutely and relatively. About 33% more reduced properties than the 5-year average, the difference between 14.1 and 10.6, although we need that updated figure for August when we get it. I'm saying about 25% more reduced stock than any normal market, a pretty good ready reckoner. 1 in 7 properties on the market have been reduced every month, so we're probably looking at 90 to 95,000 price reductions a month at the moment, to be clear. If you think you can't find a deal at the moment, just keep the legwork up and you will get there. You don't tend to see 14+% of stock being reduced in any strong markets by any stretch. So this is why sideways pricing will probably continue, depending on where you are in the country. 25,000 homes sold subject to contract. That's a quieter week, but the 2025 average is 26,500. So still pretty healthy for an August week. Sold subject to contracts up 7.1 year on year, 14.3 on 2017 to 19, and still nearly keeping pace with 2022, which to this point was a very hot market indeed. Sold subject to contracts up 7.1, listings up 3.7 only on last year. More transactions than 12 months ago to this point in the year for sure. Or to put a different way, comparatively, this looks like a more functional year than 2024 was. We went into August with 763,178 homes on the market, 5,000 up on July's number. For context, as the market got stickier before the pandemic, that number was about 660,000. And a seller's market, you'd be looking at under 600,000 on the market, really, in terms of numbers anyway. At the end of July 2024, 716,000 were on the market. So we're seeing more higher highs, but this flat feeling I've been talking about in the market for some time is just continuing to manifest itself through the summer holidays, which is what you'd expect. You're not going to see any major changes to the market in the summer holidays. In the school holidays, too many people away, aside from anything else, people not as motivated to move as they are when they come back to September. Second month in a row of not moving too far forward, fewer than 1% more homes on the market compared to the month before. So are we at the peak or are we near the peak? I don't read too much into August anyway, but there's always this extra surge in September of listings when the school holidays are over, but there's also a clear out of no hoper stock where vendors can't take the medicine the corporate agents are trying to prescribe for them. So we probably need to see those figures before drawing conclusions. As a great man once said to me, the only thing wrong with a property that's on the market if it's not selling is the price. But let's see all those August figures before drawing any more conclusions, because they might be somewhat different this year because there's just so much stock out there. So how much will be withdrawn? Don't know. Chris also takes a look at the square foot per square foot on sold subject to contract properties, because it's got such a strong correlation, 92% correlation coefficient, with prices that hit the land reg in about 5 months' time. So it's very good for predicting what the ONS are going to say. Much better than the Nationwide and the Halifax reports anyway. This time around, July was at £344.78 per square foot. That was 1.97% up year on year and 3.85% up on 3 years ago, July 22. Down about 0.5% on June's number, though, which was 346.45. Again, that sideways market I've been talking about. But I think we're looking at a 2 to 2.5% print for 2025. On my original prediction at the start of the year was 3.75, but 2 to 2.5 will be well below inflation, below wage rises and the likes. But at the risk of being a broken record, it's all sideways, sideways and sideways. Fall throughs nudged back below the long-term average of 24.2. They hit 23.6. Basically pretty normal. Very little volatility around this long-term average for many weeks now. The net sales are still there or thereabouts. 19,000 in week 31, 5.8 up on last year and 10.6% higher than pre-pandemic. So we're not quite talking 2022 levels, but let's see where we get to by the end of the year. I think it'll be a close run thing on transaction volume compared to 2022, and it will have been a much less volatile year, assuming Rachel Reeves doesn't do a full Liz Truss quasi-quarting, which I don't think she's going to. I always give Chris a weekly shout out on here because he's more prolific than just this epic tome he releases weekly on the UK property market. He comes up with great stats on a regular basis. I'd encourage you to drop him a like, a subscribe, and all the rest of it, and some kind words for his content creation. If you're in the industry and you want some support growing your business, or to be a more effective communicator, be more in touch with your local market, that's his core business, give him a shout. The article gets published on the Property Industry Eye website and the video on his YouTube channel, which is at Christopher Watkin. Okay, time to surf the macro waves once more. It's a big week. The first two really pick themselves. Unemployment and the labour market, a must read. GDP growth, and in spite of some overall scorn being poured from the likes of me, aside from anybody else, there was some, after a very strong June, hit the books. The RICS house price balance for July has to take the third slot, as the surveyor's take on this sideways but functional market has given us plenty to think about over recent months. And then at the back end, gilts and swaps. But if you've watched before, you knew that, right? The labour market then. The headline number held for the first time since February rather than keep on going upwards. 4.7% for unemployment if you're keeping score. There's ongoing shade, and there has been for years, about the accuracy of the ONS jobs data. And the ONS send us a reminder in the report that it's still a work in progress. A lot of this is done by survey, you see, the labour force survey, and therefore there can be inaccuracies and sampling errors, as you might imagine. And there's always a fear in a survey that people aren't telling the truth. But the news really isn't as negative as the headline rate, however, mostly because economic inactivity was just so high after the pandemic. So as a reminder, you split the market into employed, unemployed, economically inactive, which means people who are not seeking work. Why not? Well, genuine illness, could be short-term, could be long-term, burnout, the great resignation, all this special stuff that happened after the pandemic. Of course, nothing special about sickness, but there was more of it after the pandemic. There are a whole number of other reasons as well, but those economically inactive are down. This is a positive, and the inevitable result of this is that unemployment would rise, because if you think about it, if there's more people in the market than there were a little while ago, then you're going to see a change in activity, right? They're coming back, but you don't walk straight into a job, even if you want one. It's not that easy. Would that it were. But the inevitable result is unemployment rising. But I'd be a lot more comfortable about this if the rate of the vacancies that there are in the job market wasn't dropping like a stone, which it is. And if there was workable communication from our ruling party about job creation, which aside from public sector jobs has been sparse to say the least. I don't see a private sector job creation plan or strategy in place at all. I think they just expect the private sector to sort of get on with it, and they sort of tolerate them, is how it feels. But how do the numbers shake down? 75.3% employed, 4.7% unemployed, 21% inactive. Now, unemployment is measured at people who are over 16 and above. The other metrics top out at age 64, because if someone's 65 years old and above, is seeking a job, they're registered as unemployed. So those three numbers end up adding up to 101%, which is pretty typical for the ONS in this category. So it just tells you how many 65 plus people are unemployed. And of course, they're not drawing their pension till 67 these days. But I don't know why they don't just make it 16 to 66 for all three metrics because of pension ages and introduce a bit of consistency. But talking of vacancies falling like a stone, the number now is 718,000. Now, if we skip the COVID blip in vacancies, the last time there were this few job vacancies in the UK was the quarter that ended January 2015. So we're talking over 10 and a half years ago. The surveys are pretty clear. Firms are not necessarily recruiting new workers or replacing workers that have left. Public sector earnings have really started to pull away from private sector numbers. Public sector printing 5.7% on pay rises and private sector 4.8%. But the headline number, which is often quoted as the earnings including bonus, was actually down a decent chunk from 5% to 4.6%. But I don't like this number because month on month it just varies what months bonuses tend to be paid. So if you look at the difference between if June isn't a particular bonus month or it is a particular bonus month and July is, or the other way round, this is what you get. This is why I look at the number excluding bonus, because it should reduce that monthly noise that kicks in. And that number stayed stable at 5%. Now, the headlines were positive enough, and the Bank of England really wants this number under 4% for reasonable inflation to be occurring. But I'm not sure we really had too much progress there. The public sector has long lagged the private sector, and so you could look at this as a bit of catch-up. But nevertheless, where parts of the public sector continue to pay unsustainable final salary style pensions, it's never going to be heralded as good news. There's always a technical discussion over which measure of unemployment to trust, but it's relatively easy to see that the payroll employees, which you think would be the most reliable of all, since HMRC has real-time payroll information from employers, has fallen in 10 of the last 12 months. Of course, maybe more people are choosing or being forced with national insurance rises to go self-employed, but a fall in 10 of the last 12 is a clear pattern and pretty much a summary of the government's current record in charge, because they've been in charge about 12 months as far as unemployment goes. Real earnings after CPIH, which the ONS prefers as their inflation measure, inflation including housing costs, are up less than 1%, although better compared probably to GDP growth, which is 1.2 at this time, and CPI, because GDP is adjusted for CPI. And those numbers are more like 1.5%. That's real earnings after CPI adjustment. So there's not a huge difference. Wages are growing ever so slightly faster than the overall economy, but not much. They can't keep doing that forever, of course, necessarily. Otherwise, investment will get driven out, and the labour market side of things would become too strong. But we're nowhere near that sort of result. I'm just mentioning that for completeness, really. But the most positive part of these figures is inactivity down from quarter one 21.4 to 21.0. That's good progress. And it doesn't look like vast decreases in NHS waiting lists, although the direction of travel has been positive and overall news is positive on that front. We're not making incredible progress that would bring, 1 million people back into the work or back into seeking work from the long-term sick list. The lack of vacancies can't be anything other than concerning, though, can it really? When and where will this fall in numbers stop? The pace of the drop increasing, which again has to be linked with the circumstantial evidence of making employing people much more expensive, is the concern. And it has to be this week's image. So if you look on my LinkedIn, Adam Lawrence, you will find the image and the written piece, the written version of this article. So what about growth then? Well, there is some, and that's the end of that. Joking aside, what I've been clear on in the wake of the October 2024 budget is that growth from the private sector perspective would be restricted by the moves that Rachel Reeves has made. However, I've already also stated a number of times there's the potential for growth from the public spending perspective, and that also this would be much more difficult to forecast. And there are, as usual, a number of ways of measuring it, which simply serves to obfuscate things yet further, a bit like the job market data. But we know we had decent PMIs for June, because I watched the PMIs very closely, although they were almost a one-off and they receded back in July. So we were expecting an okay month for June, and the economic consensus was a 0.1% quarter. And I made no secret about the fact I thought 0% would be closer to the truth, especially as we had to absorb awful April. My LinkedIn commentary was simple. I was delighted to be wrong. We printed 0.3 on the quarter, 1.2 for the year on year, and 0.4 for June. Unless we forget the first quarter printed 0.7. So things look great, right? Well, not so much on the employment front as discussed, but up has to be better than down. The one-off for the tariffs has not been a one-off. It was speculated that the tariffs seriously blew up the growth figures because a lot of firms in the US wanted to import a lot of extra stock before Liberation Day, as Mr. Trump called it. It's a mile away from where I thought we'd be, 0.7 in Q1 and 0.3 in Q2, 1% plus for the year. Imagine if we printed 2% growth this year. Although that sounds low, that's post-inflation. It'd be a magnificent result. But my feeling is still that absolutely won't happen. But my forecasts in some of these months are turning out to be too bearish. So into the report for a bit more detail then. GDP per head was up 0.2 in the quarter and 0.7 on the year. Well, how did we get here when April was down 0.3? The magic dust, of course. April's figure has now been revised to a fall of 0.1 rather than 0.3. This starts to explain something, although 0.2 is not equal to 0.3, of course, although sometimes it is at the ONS due to rounding of things. Services, as so often did the bulk of the legwork here, they were up 0.4 for Q2 after growth of 0.7 in Q1. The largest contributor, information and communication, and delving a little deeper, specifically computer programming, consultancy and related activities. You do wonder how much of that is AI-based. Construction had a good quarter. And remember, we had this terrible flash PMI, but that was for quarter 3, not quarter 2, and expanded 1.2% for the quarter. It's a massive figure, right? Both new work and maintenance repair expanding by a similar amount. And then we get to the meaty bit, a classic ONS quote where you just need to read a little bit more. Growth in the latest quarter was mainly driven by government consumption and gross capital formation other. Well, that sounds as clear as mud, doesn't it? What does it mean? Well, changes in inventories and acquisitions minus disposal of valuables, stocking up, maybe because of tariffs, maybe because of fresh budgets for the 2025-26 fiscal year, made up to 0.2% of GDP. Well, that's a pretty chunky spend. And then another cracking quote. Growth in nominal GDP was mainly driven by increases in compensation of employees in quarter 2, 2025. And that's the sort of phrase that makes it to the Bank of England committee. We're mostly growing because people are getting paid more. See any problems here with the figures? Well, where does it leave us internationally? Behind the US, who grew 0.7 in Q2, but they did shrink 0.1 in Q1. Level with France and ahead of the rest of the G7, who printed figures that were either flat or slightly backwards. On the face of it, things look fine, and a dyed-in-the-wool Labour supporter could critique my growth forecasting for 2025 so far as politically motivated. However, I come out as annoyingly central on a political compass questionnaire. I've done many of them over the years, and I've more of a tilt towards market-based solutions than state-based solutions. But this is an evidence-based position rather than a politically motivated one. And that normally dictates more like the north and south of the compass test, which is the difference between a preference for an authoritarian regime and a preference for a libertarian regime. And once again, I come towards the libertarian, but still very central on those numbers because of my views on the market-based system. But great news at the top level. Below the surface, not a lot bears scrutiny. We know we're spending more than we can afford. The OBR have told us this year we can't go on like this, but at the moment we are. So enjoy it while it lasts, especially if you work for the public sector. Okay, on to the RICS residential market survey. Sales market conditions remain challenging, with previous signs of recovery faltering somewhat. A long-winded way of saying what I've been saying for some time, things are a bit sideways at the moment. Now, you'd expect the mortgage approval data and the banks to be a little bit ahead of the surveyors, although, of course, the surveyors provide the bank valuations. But anecdotally on the ground, we're being encouraged to list any properties we have for sale with a very realistic mindset. That's rare of agents trying to get your business, but it is symptomatic of this market. It could also be biased by the fact that we're in the school holidays. We're always realistic anyway. Not that our choice of agent is necessarily bound to know this, because often we're dealing with them remotely, aside from anything else. The numbers in the survey are one side or the other of even Stevens, apart from sales agreed minus 16% print down to June, compared to June, which printed minus 4%. Weaker prices overall, but driven by the south, as has been the case since interest rates started to normalise, and tenant demand eased as much as it has done for some time, although the landlord instructions print of minus 31% is the weakest figure in the survey since April 2020. So that's number of landlords instructing agents to act for them. Now, the Telegraph jumped on this sole point accordingly and blamed anybody who would listen. The figure is important, but it's just 1 month. If instead, as is being anecdotally reported, there are enough buyers out there, but they're volume buyers who don't use external letting agents, the survey is not a good measure of the change in the shape of the market. Okay, gilts and swaps for the week. As per last week, without too much UK news to drive rates, unemployment didn't change anything. Growth means rate cuts became yet less likely. And the momentum at the end of last week of the Bank of England meeting was drifting yields, as I reported. So we opened the week on the 5-year at 4.007 and closed at 4.093. We lost 8.7 basis points the wrong way for the borrowers. Thursday's swap close of 3.707 was higher than a month and a year ago, but only just. Again, it's very stable over that sort of time period we're looking at. Thursday's gilt close of 4.061 means the 36 basis point discount is still being preserved. Things look pretty stable in that camp. How about the longs, though? Well, the 30 years had an up week, and they opened at 5.395 and closed at a whopping 5.568% yield. And then they went on the Monday to close at a high since 1998. So the 30 years essentially at a 30-year high, near as damn it. That 17 basis point drift is basically double the drift in the 5-year, and thus the yield curve gets ever steeper still. We aren't far away from no pension funds doing anything other than buying gilts with a few inflation hedges, in my view. Perhaps they just do that by buying linkers, apart from anything else. But yeah, pretty incredible returns available on gilts. Now, after 6 years of the yield curve, don't ask me why it's 6, the yield curve goes up like an escalator from the current gilt low, which is 3 years from now, just under 3.75, up and away to this peak at 30 years out of over 5.5% a year. 1 year ago, the 30s were trading at 4.473% yield. Not bad at all, of course. How high can we go? Now, this is going to lead me very nicely into my soapbox subject. I have discussed this before, but it's that time of year. It's the annual review of quantitative tightening for the Bank of England. Buckle up, because it gets a bit technical, but it's incredibly important and significant in terms of where the taxpayer gets, in my opinion, frankly, the rough end of the stick. So the eyes always water in these situations, which is why we need our deep dive scuba masks on. But as always, I will attempt to translate a complex issue into as much plain English as possible. What I'm struggling to process more is it's almost a year since I last wrote and spoke about this in some detail. Anyway, what is the issue at hand? Well, we use the money printer to get ourselves out of trouble. What qualifies as trouble? And what do I mean by that? Well, once you've dropped interest rates to zero, right, then the central bank has got very few tools left in the bag. The next tool along, as had been experimented with in Japan for many years, and it is not a brand new phenomenon by any stretch, it's happened over the years in history, is quantitative tightening. It's quantitative easing, that's how we started it. So we printed money, and in different countries they did different things. In the UK, what we did is we put that money out there into the commercial banking sector. We even had, at one point, if you recall, an incentive for banks to lend to small businesses, SMEs, because after 2008, 2009, lending, credit evaporated, lending fell off a cliff, and there was a government incentive scheme called Funding for Lending, which was helping lenders lend money to SMEs. Because they just weren't doing it at all. Their credit conditions had completely been turned on their head, apart from anything else. And what have we had in the last sort of 15 plus years? Well, global financial crisis, Brexit, and COVID, right? In 4 chunks, we issued nearly £1 trillion worth of bonds and bought them at the Bank of England with, in theory, the Treasury's money. In the real world, this money made it out there into the financial sector. And in the case of COVID, it actually got out there beyond that, because in COVID, you'll remember it manifesting itself as bounce back loans, as grants and the likes, much more like helicopter money, not as plain as the checks issued with Donald Trump's name on them in the US, but a similar impact across a less broad base of people, rather than everyone with a social security number, which is what happened in the US. Why was it needed, according to economic theory? Well, because of this point that the interest rate couldn't go down any further. Now, it could, in the UK, we didn't go negative. In other big play in the European Central Bank, they had negative rates, negative rates of 0.75% at one point. Switzerland's done it for some time. Sweden did it. Lots of central banks did it. It could have gone negative in the UK, but the school of thought and the evidence base really around negative interest rates wasn't particularly congruent or clear. Now there's much more evidence around it because half a dozen banks or so had done it for some period of time. But at that time, 2008, 2009, decisions needed to be made. There just wasn't that level of clarity. And it was mentioned back in 2021. If you recall, Bank of England briefed the banks about preparing for a negative interest rate if they needed to go there. But real-time experiments with entire economies are not exactly the most desirable thing. What now? Well, rates have gone back up and we haven't seen a complete economic disaster. Indeed, if you look at the housing market, pretty sensitive to interest rates, or certainly the commercial property market, which is highly sensitive to interest rates, it largely absorbed this normalisation without too much fuss, mostly allowing 2023's rampant inflation to change prices in real terms without an over-adjustment in nominal prices. Real prices are, as I've said a number of times recently, lower than they have been for 20 years. And if you consider wages, and the lowest for 12 plus years, if you only consider RPI inflation and you don't worry about wages. Now, before you shake yourself, on average wages, the income tax landscape is also more favourable than it has been over all of that time frame. Other tax landscapes are not, granted. But income tax has been looked after over decades, mostly as a vote winner. Now, when rates went back up, the purist economists at the Bank of England looked and thought, oh, well, we don't need that 900 billion quid's worth plus of bonds anymore. Time to get rid of them. I smell an issue here, but to be plain about it, the problem is that they're not tasked at the Bank of England with getting value for money for the taxpayer, which is ridiculous when you think about it, but they're not. They're not ultimately. So with that in mind, they voted to embark upon a programme of quantitative tightening. So think about that, what does it involve? Well, firstly, they could let the bonds that have been issued mature on their own. The money gets passed back between the two organisations, which is just an accounting exercise, the bank and the treasury. But what are you doing with that money? Well, it's being retired, if you like, or burnt is a better analogy. If you like the money printing analogy, this is the money burning analogy, right? Even though it's electronic these days and that's for effect. Although burnt is a good analogy, apart from anything else in this context, because apart from anything else, you're burning taxpayer money. Not when you let it expire, interestingly enough, right? So no profit, no loss, right? The Treasury paid the interest to the Bank of England in terms of the coupons on these bonds, and then the money, which didn't really exist in the first place anyway, zooms back out of existence. Contracting the money supply, apart from anything else, which is disinflationary, not a bad thing, right? It's not perfect, but it does sound too good to be true, doesn't it? We had money when we needed it. We now know that money mostly went into inflating asset prices rather than really helping the grassroots economy, but nevertheless, it felt like the perfect crime. However, what if the models and the textbooks tell you that's not fast enough? Well, that's what's happened here. So the bank got actively involved in selling bonds into the open market. And here's where the problem started. If you like, address this at the accounting level. If you use what's called mark-to-market accounting, which is working out your P&L in real time, then the bank had lost a lot of money on paper. Think about it this way. A bond redeems at £1,000 face value. The bank bought them at £990, let's say. That reflects the fact that there's going to be some interest, right, before the conclusion of the bond. And it's just a figure for making the point, right? The bank then has been actively looking to sell them at, say, £950 to a real person. It'd be much more likely to be an institution or a fund, of course, in the secondary market for bonds. Loss, well, you've lost 40 quid per £1,000 bought, or 4%. Now, like I say, those numbers are proxies, but they're not miles out of kilter with reality. And remember, when yields go up dramatically, as they have done, that's exactly the same thing as saying the price of bonds has gone down. So what are we talking about here? No one kicked in here at this point and said to the Bank of England, hang on a second, why don't we let them all expire organically? Then we don't book this loss. Well, this is not part of the bank's remit, as I said, nor did the chancellors of the time, that's last time out we're talking about, make any comments. But neither has Rachel Reeves. There have been a few nudges and whispers. Remember, the central bank is independent, but still they're there to do the government's bidding. The government tells them what to target. The government tells them to target inflation, for example. Now, what sort of quantum are we talking about here? We're talking about tens of billions of pounds, real money, in this smoke and mirrors game of creating and destroying it at the central bank level. Taxpayers' money, one way or another. Then there was another problem, if you can believe it. If you sell hundreds of billions of bonds actively into a market that's of a certain size and is well established, what are you really doing? You're providing extra supply of bonds without necessarily creating extra demand. Where's the extra demand going to come from? Then when you come to sell the bonds you would normally sell, because you're rotating your debt, that's what happens at the governmental level, the only thing that has to give is the price. More supply, lower price. Lower price of bonds, higher cost of debt. The bank recognised this and, as they often do, marked their own homework. 0.1 to 0.15% is all it would cost us, they said, in terms of yields. Now, it's still yields we really could have done without, as there was a massive rise in the interest rate, an extra 0.1 to 0.15, but it sounded very low, didn't it? Almost so small as to be infinitesimal, really. I mean, you're still talking about billions of pounds a year on the interest bill for the UK, bear in mind. But again, didn't come into the bank's remit, right? It's the wrong direction, ultimately. No real argument as to why we couldn't just wait for these bonds to expire. Now, the plot thickens a bit. The FT this week published a piece on the fiscal consequences of this monetary policy. In a roundabout way, the QE black hole created or realised by QT. Or you've got to pay someday. Well, sure, but why pick the shorter term? There's a paper published from last year which does a robust job of aggregating monetary policy outcomes from around the world. As the Bank of England, you might know, was by no means the only one using quantitative easing after 2008. There is, in this paper, a much more robust method of measuring the impact of QT. They compare 7 central banks. Now, guess what they found? Well, actually, up to 0.7% was found to be the impact on the yields. Now, if you think we owe trillions and trillions of pounds, we owe nearly 3 trillion quid. 1% of 3 trillion is 30 billion. 0.7% of 3 trillion is 21 billion, right? 21 billion per year we could be talking about up to. So we're talking seriously significant numbers just on the debt cost that we're paying, right? Basically 0.75%. The difference from the bank's own numbers, saying it would cost about 16 billion over 3 years, still a waste of 16 billion, even if you accept what the bank said, right? Totally unnecessary, and just a case of not giving the bank the right remit and guidance, in my opinion, at the governmental level. We could be talking instead 60 billion of cost in 1 year, right? A huge difference. As it goes, the analysis shows that the longer the duration of the bonds involved, the more impact it has on the yield of those bonds. So in case of these strangely expensive 30-year bonds at this time, this could well be one of the major drivers of that very steep yield curve. Well, look, this is utterly unacceptable. If people really understood this, this would be a reason for protesting on the streets. Treble the theoretical raise from the employer's national insurance rise in April this year. And actually probably more like about 6 to 8 times what it truly raised when the dust settles. Although with that 60 billion, we are talking about mostly a one-off cost, not an annual cost, to be clear. But there's still that annual cost if you're influencing yields upwards. So I think instead we should have been asking for more. Why didn't we use this opportunity to get rates down rather than up? Why not try and move rates to the downside and instead of influencing the yields upwards? Well, that would mean creating more demand than we're supplying, wouldn't it? Using that same classic economic logic that I used earlier. Well, how? Well, what about if instead of selling any bonds, what about if we bought some longer dated bonds to replace some of the expiring debt at a rate that worked? And to give you a rough idea of the sort of quantum of this sort of stuff here, you might be looking in any 1 year at about 80 billion of bonds expiring. So I'm not suggesting we buy back another 80 billion quid's worth. But if we bought the longs and bought 10 or 20 billion quid's worth, that would bring the yields down rather than forcing them upwards. And we might be seeing the 30-year debt at 4.5% instead of 5.5%, which still be net tapering down our book of what our central bank owns in terms of bonds. What's the downside? If anybody's listening who thinks they can tell me a downside, please do. I would love to hear it, right? Perhaps, we're replacing maybe 20 or 30% of what expires in face value with terms of longer dated nominal bonds. And there'll be much cleverer people than me at the Bank of England who could tell you, well, actually, you should look at doing 15% or 35%. I don't know. But if I was involved in government, that's one of the things I'd be asking them. What about if we bought some index-linked bonds back rather than all these linkers that we've sold to reduce the government's own exposure to inflation, which by design it cannot control because of the independent central bank having the remit of controlling it, right? What's at the centre of my logic? Well, this recent run of events is historically notable. A financial crisis, widely accepted as a 1 in 75-year event. A pandemic, widely accepted as a 1 in 100-year event. How can we expect it to get over those in such short time frames? It would be much more appropriate to describe an initial response, which was significant in both cases, and then a repair period that was in the decades, which allowed for similar cautious repair by the central bank as well as the government. Now, whilst I appreciate the comments I attract on a regular basis for my analysis, and look, I've got 2 master's degrees with a healthy dose of economics in them, I went to Oxford University, blah, 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 but I cannot give you an argument for getting on with it so quickly as the Bank of England have done. Now, for those who, again, listen regularly, they know that when I go and see the regional representative of the bank, great man, lovely guy, and I've asked him the question, not in the room, but outside of the room, and I've never really had a robust answer for it, I'm afraid. It is a really public sector approach to the whole problem. That's not our remit, that bit. But we're talking about tens of billions of taxpayer money, right? I can't fathom public sector mindset in that department, I'm afraid. It is ridiculous. There should be bank whistleblowers going to the Financial Times about this, and should have been for years. And to be clear, the vast majority of the damage has been done because these bonds have already been sold, right? So it's not, but we could still change. We could still adopt my policy today and fix some of the longer term yields and the excessive amount of debt that we're having to pay out. But yeah, the damage has largely been done. And when I go on this rant on an annual basis, getting more and more worked up every time because they still seem to be not really doing the right thing. Well, what's the closest proxy to this in historical government cock-ups apart from anything else? Probably Gordon Brown's gold sell-off. Wait until a period of historical lows in the prices, highs in this case, because we're selling to crystallize a paper loss that just doesn't need crystallizing, and then sell it, right? This is the worst possible timing. Buy high, sell low. Exactly what we've done here with bonds, and we all know that's not smart. At the base level, you should be buying low and selling high, right? Now, the summary of the FT piece this week, well, the policy review for September is under pressure to slow or reshape QT. Now, ideally, that would be in the way that I've said, but I don't see it happening. But it will be quiet, niche, hardly reported on and barely understood. A total disgrace in my book. I hope that I've done something this week to help you try and understand this situation. And it genuinely is one of the great financial scandals of modern times. I really am not being over dramatic by describing it as that. Forget PPI, forget, car lease, commissions and all the rest of it. This is just a waste of money on an epic tens of billions style scale. Okay, so before I do close, don't forget to book your super early bird tickets to our next property business workshop. Rod and I are running it on Wednesday, the 1st of October, Central London, and this time round, investment metrics and how to run your property business at scale. My favourite topic of all. Please book at bit.ly/PBWEIGHT. And above all, please remember to keep calm, always listen to the supplement and carry on. There's going to be opportunities this year and towards 2030 and beyond. The landscape has now been set for a surefire bull run. It's going to be slowish to take off if we look at it on a week-to-week basis. It's going to take a little while to get off the ground, and the amount of stock around is keeping things suppressed at the moment, as I keep saying. But as yields currently continue to improve on property, it's a case of here we go, in my opinion. Thanks for watching, folks.